Mortgage rates just hit a 10-month low, and here's what smart buyers are doing right now. Imagine this: you've been sidelined by high interest rates, watching the real estate market from afar and waiting for rents to signal that they're going to go down, but they haven't. But suddenly, rates dip to a 10-month low, and the Fed is signaling cuts and whispering of a buyer's surge to fill the demand. No more waiting. Things are about to get way better. If you've been holding off on that dream home or that investment property, more importantly, this should be your golden window. Stick around for the next 8 minutes as I break down what the data says, how the Fed is likely to move, and why smart, low-leverage buyer strategies are winning big right now. So let's dive in. So here's the thing. When I hear that mortgage rates have hit a low, even if it's a 10-month low, it's a signal. And I pull back and I look at the bigger picture. The Fed is already pricing in a cut for next month. That's September. And the reality is when these are things that are aligning, this is what goes through my head as an investor. Because interest rates are followed very closely by cap rates. To back up and show you what a cap rate does, a cap rate dictates the purchase price that someone is willing to pay for the cash flow that comes from an investment. And the lower the interest rate, the lower the cap rate. That means the lower cap rate facilitates a higher purchase price. So when I see that interest rates are starting to go down, I know that real estate prices are going to start to go back up. And it's not because of inflation. It's not what you think. It's because we are seeing a better interest rate, which allows more of the cash that comes in every month to go into the investor's pocket rather than go to the mortgage company. So as you see mortgage rates come down, cash flows go up, people can pay more, they're still going to wind up with about the same cash flow because that is determined by a DSCR, which is a debt service coverage ratio. This is all very important because if you're buying today and you're looking at it and saying, hey, I'm going to get a 5.5% mortgage, but I know that over the next 12 to 18 months, rates are going to trend lower. That means that when we refinance 1.5 points lower or 2 points lower, we're going to pick up another point on what we can sell the property for. So if you have a property that's doing an NOI, net operating income of $1 million, then you have a purchase of that property in today's market. You're going to purchase that for a 6 cap. That means that you're going to get a 6% return on the total purchase price of the property. Now you're going to pledge some of that to the bank and all those different kinds of things, but at the end of the day, if that goes down to a 4% interest rate, then that's likely to bring the cap rate down to a 5 cap. That 5 cap is going to allow for either cash out, which is money back into your pocket, tax-free, or it's going to allow for better cash flow. Now, when you've done the better cash flow, now you're getting a higher rate of return on your investment because you bought based on a 6 cap. It's now a 5 cap. And on $1 million NOI, that can be hundreds of thousands, if not millions of dollars that you've made just by locking in a lower interest rate as rates continue to fall. So here's the other thing. I've been through these cycles before, and they happen often. What we went through in 2020 is extraordinary, but it's not a once-in-a-lifetime event in the fact that interest rates come down, prices go up. So here are 2 of the biggest mistakes that people make when the market starts to turn in their favor like this. You know, I remember a time I was building a building for the region's largest single-family home builder, and I called him and I said, hey, Corey, what are you seeing? You've got to be really excited the Fed cut rates 1/8, right? This was back when 1/8 was a big rate cut. He told me, he said, I absolutely hate this. And I go, why? That means they can buy more house. You can make more profit because you're running on a percentage. He said, I hate it because people wait until it bottoms out. And that's what most people think to do. But there's something that's said often, and it's kind of cheesy, but it really fits. You marry the asset, you date the rate. Because if you're buying in today's market and it cash flows at a 6% mortgage rate, and that rate falls 1.5 points to 4.5, you're going to be either in a much better cash flow position or able to refinance, get cash back out. And when you do that, you'll be in a position to go make another investment with the capital that you pulled back out. And if you don't want to be someone that guesses all the way around, which a lot of people do, they call it investing, but they're really gambling and guessing. But if you want to be somebody that doesn't guess your way through these moments like this, check out our guide, 7 questions every accredited investor should ask themselves before wiring capital. It's in the link below, and it'll help you stress test opportunities as the market reopens. And it's totally free to hit the link in the description. So let's talk leverage. If you're looking at today's market, you may need to bring more capital than you're used to. And when I say used to, when I did my first deal back in 2000, I had to bring 35% cash to the deal. That seemed normal. That was just what it took to get the property to cash flow. I didn't fully understand DSCR at that point in my life, but the debt service coverage ratio that most banks want to see is 1.25. That means that if you have a $100,000 annual mortgage, you have $125,000 in free cash flow. That means you've got money to take care of maybe incidental repairs that come up, maybe there's a capital call on the parking lot or something like that. You've got opportunity there to be able to fund your way out of an issue so it doesn't upset your apple cart and you have to reach into your pockets. But when you're looking at that and the bank is saying, hey, you can buy an asset today, we're going to take a $10 million asset. And they say, hey, Shannon, you want to buy this, you need to bring 35% down. That means I have to bring $3.5 million. Now, I don't like that because I don't get the best rate of return. If I'm buying a 6 cap property, I'm getting a 6% return. And personally, I like a little bit better leverage than that. I like to make a better return on my investment. And maybe I've got the bank in there at 5.5, so I'm arbitraging a 0.5 point on their money, but then interest rates fall to 4.5. When they fall 1.5% or 1%, then I'm able to either A, make more cash flow, or B, refinance, which is what we're talking about right now. So then if I can do that, I can put myself in a position that my cap rate has gone down, which means my value has gone up on a $10 million property. If we go from a 6 cap to a 5 cap, you're probably looking at about $800,000 to $1 million. So when you're pulling out $1 million in capital back of your $3.5 million, you're going to get about a 30% return of capital. So now you have $1 million to go do something else with, or you can elect to just have better cash flow. Most investors I know would take that additional funds back out because the bank will not allow you to get below a 1.25 DSCR, so you're still going to have good coverage. Then you can take that $1 million and go buy an additional property. If you're still looking at 30% down, that buys you a $3.5 million property. So when you start to look at how leverage works in this kind of environment, now is really the time to be buying things. Because if you're buying it based on putting in $3.5 million, you're getting something that cash flows, it's not doing awesome, but it's doing cash flow. You're going to see rents continue to appreciate. And as rates drop, you're going to see the ability to leverage that higher and higher. We saw this in 2020. People that had bought things in 2015 were able to get all of their money back out, and then they were able to go buy an additional property, now creating leverage on 2 properties out of the value of 1. So now they're looking at a 3 to 5% appreciation annually on 2 properties. So now they have $20 million in their portfolio. It's spread over the same amount of leverage. The debt is locked in for a long period of time. And this is a very key thing. You need to make sure that as interest rates drop, you lock in your debt. Short-term debt is not your friend because they're not going to stay, as the last 2 years have just shown us. So when you get to that lower leverage and now you have a $10 million asset, you pulled $1 million out of it, you've got $2.5 million, you're at a 25% down payment, a service coverage ratio of a 1.25, and you're at 75% leverage. So you've got a great thing going. So if someone's looking at that, they need to understand what this looks like and why now is the time to buy, because you're going to be able to create value simply with the interest rates. And this is going to impact your bottom line tremendously. This actually does not have a lot to do with their monthly numbers because you're going to pull capital out. Your payment will remain about the same, but it will increase your IRR because you have lower amount of equity in the deal. So now you've only got $2.5 million. You're still making that 25 bips on what you have in. So if you've got a $10 million property, you're still pulling in cash flow but you have less cash to do that with. So this allows you to do those kinds of things, and it's all about understanding the market and where it's headed. And there's a lot of excitement, but some people think we'll stay higher for longer. And that's okay, because what I'm positioning my company to do is the same thing that I've always positioned my company to do. Underwrite good deals and buy them and build them. So if you look at underwriting the good deals, you're still going to underwrite the same way that I do. I have not changed my underwriting in years. It's still the same. I still look at the worst case scenario. I still look at the best case scenario, and I come up with a scenario that plays out with the timeline that I'm looking at. And most people have made a huge mistake in this area in the last couple of years that have gotten into real estate because they have looked at very short horizons, 18, 24, 36 months. And I will be honest with you, we are guilty of that. We have taken advantages of sales at 20 months when maybe we should have kept it longer. But what we saw was that we were reaching our 7-year goal in that 20 months, and we could go do it again. But let's pivot to price. When rates fall like this, how do values respond? And how am I advising my clients in a market like this to take advantage of it? Well, first of all, we're in Boise. And Boise is a little bit of a subsidiary market, tertiary is what they call it, and it's a secondary city. But this is where a lot of people are moving to. This is also where we see tremendous wage growth. And I can't say this often enough. Rent growth comes from wage growth. So you need to know what your city that you're investing in is doing in that particular area. So if I had a family member sitting on the sidelines right now, the single best piece of advice I could give them in August of 2025 is to buy the property. Bring the down payment that's necessary, get the 1.25 DSCR, get that finance rate locked in, because let's be honest, the rates that we have now are not terrible. They're not what we've been used to over the last couple years, but they're not terrible. And make sure that the property cash flows. Once you've got that done, buckle up, Buttercup, because as rates continue to fall, prices are going to continue to go up, and you're going to see the ability to refinance and pull out large chunks of cash and redeploy them, and it's really going to blow up. It's going to be another market like we saw coming into 18 and 19, depending on how far down interest rates go. But 1% does a lot for you. Just check your spreadsheets. So if you want to know what kind of markets are at risk of blowing up rather than prices blowing up, you want to watch this next video, The Silent Crisis That Could Destroy Your Long-Term Wealth. It's up next on the channel, so click it now, and I'll see you there.